Hello, I'm Jeffrey Ham, equity analyst for Briefing.com. Today is Thursday, March 27th. Packaged food company ConAgra topped third quarter estimates and provided an earnings outlook that bested the consensus full-year estimate earlier this morning. The company also announced it will be divesting some of its non-strategic assets. While the food company's healthy report is giving its stock a boost in early trading, better long-term opportunities exist in this industry. During the third quarter, ConAgra generated 63 cents per diluted share, well ahead of the 41 cents per share that analysts were expecting. Earnings per share climbed roughly 70% since last year. Total revenues climbed nearly 21% year over year to $3.5 billion, helped by strong food and ingredient sales and a jump in trading and merchandising sales. ConAgra reported that sales for its consumer food segment, its largest, grew 8% year over year, while food and ingredient sales climbed 24% from last year. International food sales were up a mere 6%. Sales from ConAgra's trading and merchandising segment nearly doubled to $564 million as a result of volatility in commodities markets. Importantly, ConAgra decided to divest its trading and merchandising operations, which can be viewed as a positive move. Though the segment has helped produce sizable returns in recent years, ConAgra's focus should be on simplifying its business model and growing its consumer foods business. Focusing operations increases the dependability of earnings and cash flow. Despite the decision to rid itself of trading and merchandising operations, management offered an encouraging outlook for the year. 2008 earnings are expected to range from $1.80 to $1.85 per share. Wall Street estimated full-year profits would total $1.60 per share. ConAgra's third quarter results are favorable and support its candidacy as a value play. As of yesterday's close, ConAgra's price-to-earnings ratio and dividend yield were more attractive than those of peers Kellogg or General Mills. Shares of ConAgra were trading at roughly 12.9 times trailing earnings and offered a dividend yield of 3.5%. Shares of Kellogg were trading at a more pricey 19.5 times trailing earnings, while yielding a 2.4% dividend. Shares of General Mills were trading at 16.4 times trailing earnings and offered a dividend yield of 2.7%. Still, shares of both Kellogg and General Mills have outperformed ConAgra this year. Year to date, Kellogg has seen its share price slip a mere 1.5%, while General Mills has seen its stock climb 3.5%. ConAgra shares have fallen 8% this year. Shares of Kellogg and General Mills will likely continue outperforming given their fundamental strength. Both Kellogg and General Mills boast healthier margins than ConAgra and also have a larger international presence. That multinational footprint allows international players to continue benefiting from rising global demand and a weak dollar. With fatter margins, heftier sales turn into heftier profits. In turn, such fundamental strength affords Kellogg and General Mills better growth opportunities than ConAgra. I'm Jeffrey Ham for Briefing.com. Thanks for listening and have a great morning.